Hi, my name is Rubin, and I'm your retirement plan advisor. Today I want to talk to you about what happened in the first quarter of 2013. We had pretty low expectations for this quarter. After all, we had sequestration, the Bush tax cuts expiring, as well as the payroll tax increase and problems in Europe. Now, as it turns out, the first quarter of 2013 ended up being a pretty good quarter. So let's go ahead, take a look at those numbers and see how they went down. As you can tell, the US did much better than international, generally speaking. US small caps were the high performer for the quarter at 12.4%, but closely followed behind it was US value stocks at 12.3%. Now, US large cap stocks still did well, as did US REITs. International did okay too, but emerging markets definitely was the only loser this quarter, and the bonds plodded along as they always do. Take a look at these categories over a rolling 1-year, 5-year, and 10-year period. We can gain some historical perspective. Now, over the last 1 year, US large value has outperformed everybody, but not far behind is US small value, and international has lagged. Over a 5-year period, again, US has outperformed international by and large, and even international value has been negative. Now, what's interesting is this 5-year period also includes the great crash in October of 2008, as well as the great crash in the third quarter of 2011. So what we learn is that if we're disciplined and well diversified, we can fare out some pretty bad storms. Now, looking at the 10-year, what we learn is that even though things in the short term may look tilted towards the US, in reality, things can go towards international. And as we see here, emerging markets, which was, as we mentioned, negative in this last quarter, turns out to be the best performing asset of the last 10 years. Now, that's not to say it's going to continue being the best performing asset over the next 10 years, but what we can see is being diversified is very important and can make a huge difference in returns. And when we look at portfolios, we can tell that being in the market this quarter paid off. If you were 100% in stocks, diversified across several categories, you would have returned 8.1%. For that rolling 1 year, 12.2%. But when we look at the 5-year, again, which includes that big downturn in 2008 and the downturn in 2011, you were much better off in a mixture of stocks to bonds. And over the 10-year, again, definitely better off being all in the stock market. But what's really telling is that 10-year volatility. And the volatility tells us how much the market has been moving over those 10 years. So again, if you're one of those investors who doesn't like sitting idly by while the market goes up and down, it makes you very nervous, having more in bonds makes sense. Now, generally, you want to be a little bit in the stock market because that will keep up with inflation along the way. What does the second quarter of 2013 have in store for the stock market? I don't know. I don't have a crystal ball. But there are some issues on the horizon. North Korea will continue being a problem. Sequestration needs to be dealt with, and Europe is far from being taken care of. But overall, I believe that we should be optimistic. As long as we're in the portfolio with the correct stock to bond ratio, we have reason to celebrate long term. Thank you very much for joining me today. I wish you the best of success in the second quarter of 2013.